Ladies and gentlemen, please take your seats. So I'm really happy to welcome you here to this event. My name is Dominic Paravicini. I'm head of SECO, one of the partners of this panel today. I warmly welcome also Patrick Odier, who is sitting here with us. And it is really my pleasure to welcome you all to this Building Bridges session on innovative blended finance solutions for impact. It is hosted by Swiss Sustainable Finance, the SDG Impact Finance Initiative, and the SECO, the office I represent. Ladies and gentlemen, blending is trending. We see an increased interest for blended finance to support and accelerate impact investment. And we need to do so. Impact investing with measurable positive results on society and for the environment remains currently a niche representing only 5% within the sustainable investment approaches in Switzerland. The reach of the SDGs has shifted further away. Poverty and indebtedness has increased because of the COVID pandemic, but also due to the energy and food crisis. We even see here in Europe how hard it is to ensure the energy supply while transitioning to a green economy. It is in this challenging situation that we need to join forces if we want to provide solutions. I am encouraged to see that Switzerland continues to be a leader for impact investing, managing a third of global impact investments into emerging and frontier markets. Building Bridges is a vivid testimony that the financial sector is ready to contribute to a more sustainable planet. The SDG Impact Finance Initiative has generated very promising proposals, I will come to that later, addressing systemic issues and helping to create new markets. Sub-Saharan Africa continues to be the most common destination for blended finance flows. The region saw a significant uptick in blended finance activity in 2020 compared to previous years. Commercial investors represent almost 1/3 of blended finance transactions, commitments, and there is certainly room for crowding in more. And finally, the leading platform for blended finance, Convergence, has over 200 members, more than half of them from the private sector, and the rest from the public, foundation, and research side. In this session, we talk about blended finance for the SDGs in developing countries. I'm on this position only for 1 year, and I must admit that I struggled with this idea of blending and how it works exactly. But it was explained to me, in a way I do understand then, that it's like mixing a cocktail. You blend different ingredients in different proportions. Seed capital from public or philanthropic sources with private, commercial capital for impact investment with technical assistance. Instead of a lime slice or an olive, you put in a guarantee or a first loss tranches or pay for result mechanism. Mostly there are concessional funds involved, but there can be blending without concessionality. So staying with the idea of a cocktail, there is one for every taste. Let me give you an example. When SECO teamed up with the UBS and Symbiotics to launch a fund dedicated to SME finance in developing countries in 2016, the first loss tranche of SECO for 2.5 million Swiss francs to mobilize an additional 45 million from private investor was never called and returned to our Ministry of Finance after the fund was closed. Our goal at SECO is to maximize the impact of taxpayers' money that is given to us by Parliament. We dedicate significant resources to improving framework conditions in our partner countries, improving public financial management of the business environment, streamlining import-export regulations, or introducing a sound legal environment for infrastructure investments. These structural reforms are complemented with demonstration projects or approaches using blended finance in a strategic way to open up the way for further quality investments. The Private Infrastructure Development Group, PEACH, to which SECO is a founding donor, leveraged 12 times more private sector funding over 20 years. It did so mostly in the area of renewable energy, but also transport and digital communication infrastructure in developing countries. SECO has a long history of blended finance using all ingredients, starting with microfinance and renewable energies in the 90s, and we are proud of this. So if you speak of mobilizing private capital for development purposes, please come speak to us. Let me share with you some important lessons we learned on this path and our experience in this field. Provide early-stage technical assistance and funding to support innovative ideas. Why? Because the design stage, I repeat, the design stage is the most underfunded area of blended finance. Our SDG Impact Finance Initiative is addressing this gap with the innovation window. Second, planned competitive calls to increase value for money. In 2017, SECO launched for the first time a call for proposals for grants to technical assistance facilities linked to impact investment funds. By defining the contribution to selected SDGs, it stimulated innovation and introduced SECO to new approaches. To give you one example we are proud of, it is the Meloy Fund for Sustainable Fisheries in Indonesia and the Philippines that was awarded $1 million for technical assistance. It helped companies to improve financial management, operational efficiency, and corporate governance. It also supported efforts to steer small-scale fisheries towards sustainable practices, develop seafood supply chains, and provide accurate fisheries impact measurement and reporting. As a result, hundreds of jobs and thousands of indirect jobs were created. Sales and profit of companies increased, and many tons of CO2 were saved. In addition, the technical assistance facility provided a COVID relief package in 2020, which was necessary to support fisheries. This flexible use of technical assistance was critical to maintain afloat the supply chain of sustainable sea products, which could quickly restart after the pandemic. The Meloy Fund will now be closed, having reached a positive return, and a new purpose is being established. Let me continue mentioning 3 more points of what we have learned on this way. Bring together concessional funds, meaning public and philanthropic funds, to get better blended finance deals and reach scale. Here, the amount makes the difference. This is something that the SDG Impact Finance Initiative is addressing and will be discussed later this afternoon. Demand quality impact reporting to show you're making a difference. A lot has been recently said about ESG and impact washing. As a public donor committed to reaching the SDGs set out in the Agenda 2030, SECO measures, monitors, and reports on intended and unintended impacts of its interventions. Finally, support market reports to provide transparency and benchmarking as a public good. Early funders need more transparency and benchmarking, which will contribute to a healthy development of the market in order to make informed decisions and use public funds effectively. Key information, including financial reporting and information, are needed for making decisions. This information is still difficult to find, and hence it remains difficult to compare best practices. This is why we have decided to support for the first 2 years the Private Asset Impact Fund report, which enhances transparency and benchmarking for about 2/3 of this industry worldwide. We expect that these kinds of reports will become an important instrument for public donors to identify projects where the impact leverage is at its highest without substituting private actors. With this said, I'm very happy that 3 distinguished panelists from key players in the blended finance space, somebody from Private Infrastructure Development Group, PEACH, IFC, and Allianz Global Investors will be discussing questions around blended finance and how to leverage private sector investment for the SDGs. I'm eager, and I'm sure you are as well, to hear their thoughts on how to scale impact investing from this niche of 2% I mentioned at the beginning to get it bigger. The second part of this session will be dedicated to the SDG Impact Finance Initiative, a public-private partnership that uses blended finance to advance measurable progress towards the SDGs. SECO, UBS, Optimus Foundation, Credit Suisse Foundation, and our partners SDC proudly launched the initiative at the last edition of Building Bridges last December 2021. 10 months have passed since then. The initiative has launched its first competitive call for proposals in partnership with Convergence. Together with our partners, we would like to inform you about the progress achieved and planned next steps. Here, let me sincerely thank all the partners involved, namely Swiss Sustainable Finance, Convergence, Peach, IFC, Allianz, Global Investors, and Building Bridges for the opportunity to exchange on this important topic. I look forward to an insightful session and debate. So, cheers, everybody. Thank you so much.
Thank you for these introductory words, Dominic. Good afternoon to all of you. It is my great pleasure to welcome you to this afternoon session on behalf of Swiss Sustainable Finance, the co-organizer of this event. I am the CEO of SSF and will have the pleasure to moderate the panel that we will soon tackle, how to achieve scale and reach the next frontier. For me, it's such a great pleasure to be here today. You mentioned it. It's 10 months after the last event we jointly organized with SECO at the last Building Bridges event. And now the SDG Impact Finance Initiative is up and running. And I'm sure you can't wait, as I can't wait, to hear which are the finalists of this first call for proposals. But we know a lot has happened since the last Building Bridges session. We also heard it yesterday and today during the summit. There's so much on the move in this whole sphere. And we now want to learn from practitioners how they bring blended finance tools further to actually contribute to solving some of these immense challenges we all face out there. And for this, I would like to directly dive into the panel and welcome two of the panelists in personam here on stage. And I start with Leticia Ferreras Astorqui. She's Portfolio Manager for Development Finance at Allianz Global Investors. Please join me here on stage. And we also have online Cruzcaya Sierra Escalante, Senior Manager Blended Finance at IFC. So hopefully we'll manage technically to get her into the panel. And now I also ask to the stage Marco Serena, who actually replaces Philippe Valau, CEO of Pitch. Marco is Head of Sustainable Development Impact at the Private Infrastructure Development Group. And he will also join the panel, but seeing that he will give the first intro speech, I rightly give you here, ask you to join me here. Thank you.
Thank you, and good afternoon, everyone. And yes, as it was said, apologies, our CEO had a dental emergency, which doesn't sound great. But so I'm very happy to be here and share a bit of the experience of the Private Infrastructure Development Group. I'm going to try and explain what we do and also share a few lessons and a few of the challenges that we've seen in blended finance. So we are a project developer. We are an infrastructure investor in Africa and Asia. 50% of our projects are in so-called least developed countries. 50% are in fragile and conflict-affected states. So we do operate at the frontier. We've been set up about 20 years ago now, actually 20 years this year, where blending was not trending. And so we were not called a blended finance institution, but effectively we are. It is thanks to 4 governments at the beginning, including Switzerland and SECO, that we were set up. And we overall, over the 20 years, we've received in official development assistance from our co-funders about $1.7 billion. We've invested that. We used that to attract additional funding and invested that several times over because we don't redistribute profits. So from that 1.7, we went to about 4.6 billion of investments in very frontier countries, as I mentioned. And those investments are worth a total of 37 billion, of which 23 from the private sector. So the multiples are there, but most importantly, these represent about 200 projects now that improved access to infrastructure for over 220 million people in some of the most difficult geographies where SDGs are lacking and where climate adaptation is a real priority. So how did we do this? We do operate across the entire infrastructure cycle. So from the very early stage, which is the underfunded part, about 10% of investment of the overall cost of projects will then attract the rest coming in, but it's very risky and it needs patient capital. So we provide that, we provide TA, we provide what we call viability gap funding as well as guarantees long-term debt. And I think a couple of successes that we've seen. I'd like to highlight both at the level of the organization and the instruments, as well as the level of projects. So if we look at the organization overall, I mentioned some of the numbers already and the multiples. Overall, this is still a drop in the ocean, but it's proving a model, which I think is the important thing. So the first instrument that was set up as part of the group was a debt fund. And when that started, it started with official development assistance money. Progressively, it managed to attract institutional money, including from Allianz. And so that became progressively the majority of the fund. Now the fund is a 1 billion fund, investing exclusively in Africa, mainly in renewable energy, and 65% in least developed countries. Moody's rated the fund A2 this year. And on the back of that rating, we are raising further capital in the market. So that is an example of a 20-year blended finance fund that has got a track record. That track record has been assessed. And as part of the rating, the initial support and the continued support from the governments is essential. So that's I think one of the messages that I'd like to share. We've seen also success at the project level. And where blended finance works best is where it needs to bridge the gap between what are legitimate return expectations with the affordability questions. And that's a critical question for infrastructure where infrastructure is not built. So we keep hearing about the trillions that need to be mobilized and the transition finance and the need to put that, to direct that towards emerging markets. But the challenge in emerging markets, and especially in least developed countries, is that the projects are not there effectively. So in order to bring projects over the line, bring them to be operational and then investable by institutional investors and others, blended finance is key. And some examples are some of the first independent power producers that we brought to light in countries like Malawi, where that patient capital was needed at the very beginning together sometimes with TA in order to get the project over the line at a tariff that is affordable to the utility and to the country. Water is another example. You're probably familiar with one of the few PPP projects in Africa on water, which is Kigali Water, where viability gap funding was essential in order to keep private sector developers, private sector lenders, as well as maintaining an affordable tariff. But let me speak to the challenges as well, or some of the challenges that we're seeing. So the first is that blended finance is focusing on the instruments and often focusing on the large amounts and at the fund level, and not focusing enough on that initial 10% of project development which is needed. So as we managed to do what 20 years ago wasn't really foreseeable, which was to do 15, 20-year money in Africa, in infrastructure, and create a fund that then is making a return and attracts institutional money. The next step is, how do we move from the project development piece being only funded from official development assistance or grant funding, and how do we get more funding into that piece, into that early stage? What blended solutions can we use for that? And I think that is one of the next challenges. And then, because the second one is how to make sure that I mentioned a return, blended finance bridges affordability with an acceptable return. What is an acceptable return? And that is always a difficult question to answer. And I think maintaining credibility is really, really important for the sector in that. We shouldn't be subsidizing unduly government. We shouldn't be, in the countries in which we invest, we shouldn't be subsidizing excessive returns. One example that we've seen is where we were working on, well, we're probably familiar, if you are familiar with the infrastructure sector, Nigerian solar independent power producer contracts where the government decided to renegotiate all the PPPs because they've seen highly subsidized tariffs somewhere else, and they wanted to do the same thing. Now that has stalled the solar market in Nigeria for a few years. So I think it's really important to look at that element as well. And then I think that the final thing that I'd like to touch on is the fact that is beyond blended finance, but still really, really important if we're looking at the markets in which we're investing and the issue of climate adaptation in particular, not just climate mitigation, which is that at the blended finance works where there is an economic case, but the business case is not quite there. It's almost there, but not quite there. And I think that is the definition of where we are with a number of issues like climate adaptation, urban resilience, for example. And I think the key thing is that at the moment we're still not finding a way to price in the value that we're generating in emerging markets in terms of climate adaptation and achieving the Sustainable Development Goals within the structures that we are putting in place. So I'll stop there. Thank you, and look forward to the discussion. Thanks.
Thank you. Thank you, Marco, for these insights and for joining us here. Now we see if we have Kruzkaya online from IFC. Here she is. Welcome to this panel, Kruzkaya. You join us from the IFC, from other parts of the world. Great that you can make it to be part of this panel and tell us a little bit something about your blended finance experience, the way you cooperate with private sector investors and the related challenges. The floor is yours.
Thank you very much. So let me start just by reminding everyone that, IFC is the part of the World Bank Group that focuses exclusively on the private sector. So, from that starting point, we are engaging in all of our activities as IFC with the private sector. Then when you take it to the next, part of the question, which is how have we been using concessional finance? We have been using it, for about 20 years. We started in the area of climate change in particular, and then we have expanded to a number of other areas. You see in the slide that appears, there that, it has been in climate, agriculture, and food security, gender finance, SME finance. During the COVID crisis, we also were able to, see some of the health projects, coming in, and, it has been quite a useful tool, in particular in investing in low-income and fragile and conflict-affected states, in particular with the source that we have, which is the largest through our sister organization, the IDA private sector window in particular. So, basically blended finance, the way that, we define it together with other 20 DFIs, is the combination of this catalytical capital, the concessional piece, which basically is usually provided by government, by multilateral facilities, or in some cases philanthropies as well, together with IFC's own account investment. So we use a co-investment model in how we blend, and then we are able to leverage third-party capital, primarily, from a sponsor, from other commercial lenders that tag alongside us, and also in some cases DFIs that are invested commercially. So if you take our experience since fiscal year 2010, we have been investing already more than 3 billion of this catalytic capital, of the concessional capital, which has been able to leverage more than 9 billion, from IFC, and additional resources, from third-party sources, or in more than 7 billion. That has brought, 17 billion into private sector projects. You have seen that, our experience also in terms of number of projects is quite significant during this period, having more than, than 360, projects. So perhaps we move to the next slide. A very important, aspect that I think that it's quite helpful for our partners, that give us these concessional resources for us to, to manage and deploy, is this idea of the leveraging. What can we do with the dollar of concessional resources? And you can see that, overall, and this includes, again, significant, resources that we have deployed to the lowest income countries and fragile situations. The leverage is about, $6. In some specific cases that we thought that it might be interesting, just for some practical points of how we have done it is, one case that we wanted to highlight is, a waste to energy transaction in Vietnam that we did recently together with the support that we received with the blended finance facility, a bilateral facility that we have from Finland, that we were able to, basically tag alongside with IFC with a 30 million package that was put together with third-party capital to try to support this project. I think what it is clear, from, and I think you heard it from the first panelists as well, is the idea, what are we trying to do with these resources in terms of impact? How are we going to, in this particular case, to protect health risks, how we are going to reduce, greenhouse gas reductions, as well as how we are going to try and create demonstrations within the market that could bring other plants in the country to the same, standards. So I think that's an important, highlight that we wanted to, to make. Another, quick, project that I wanted to highlight, and we go to the next slide for that one, is, a solar project that we were able to, set up in Gaza. A very difficult context of, thank you. A very difficult context in terms of, basically trying to, bring resources to, to this very, vulnerable, area of the world, but at the same time trying to help build energy self-reliance through solar power. In this case, it was a partnership that we had with our bilateral facility supported by Canada. In a smaller project, in terms of size, also this project had the benefit of, having also a MEGA guarantee. So in this, particular, case, also bringing other, resources from, other providers of, solutions in the form of a guarantee. So perhaps we go to the next slide, and I think some of these similar concepts will resonate, from the first panelist, in the sense that, when we bring blended finance to the table, we want to do it in a very disciplined approach. The idea is that we will put blended finance where it makes sense to put blended finance. I really like the description of this idea that there is an economic case that is clear, but the bankability of the transaction is somewhat limited. So for us, that's a first principle that we will use in every transaction. Then every other transaction we will think about how much is this concessional support that is needed so that we are not over subsidizing. So yes, we help balance the risk reward, but not going beyond that. The third principle that we consider in blended finance transactions is how do we help demonstrate in the market so that we move to commercial sustainability. We're also very cognizant that blended finance is not a silver bullet, so we need to ensure that there are other aspects that are also being worked, alongside the blended finance support, which is enabling environment, capacity building, making sure that, we go along with other aspects that are being supportive of market, progress, together with the blended finance. Finally, I would like to make, perhaps, a point that is quite important and dear to IFC's approach to blended finance, which is the relevance of strong governance and transparency. IFC has been a leader in stepping up, the plate into the transparency with respect to the use of blended finance. Since 2019, we publicly disclose the level of concessionality that we provide in every transactions that benefit from blended finance. We're still, until now, the only DFI that is doing that, estimating the level of subsidy systematically and publicly disclosing it across all of our blended finance operations. So we believe that this is an important aspect to show what is the level of concessionality that we are providing, so that we can make comparisons across different sectors, structures, instruments that we use. Finally, we would like to probably just highlight that these principles that I walked you through at the beginning is something that with 20 other DFIs, IFC, who chairs the DFI working group on blended concessional finance for private sector projects, has put together. And this is something that all of the DFIs in the working group work together to make sure that the application of these principles is core to our use of blended finance. Perhaps I will finalize by highlighting the big gap and the importance right now that is for us to think how we stretch these very helpful resources on concessional finance to the most needed situations. We see huge gaps, in particular in the climate space, in many cases in the middle income countries, because that's where the climate mitigation projects, are, but also with the multiple crises, that we see in, significant gaps as well in food security. Anything related to, fragility is something that we see gaps, as well as to support important transactions around gender finance and gender entrepreneurship. So I'll probably stop there, but very happy to continue the conversation in the panel. Thank you very much.
Thank you very much, Cruz Gaya, for these not only practical examples of concrete finance projects, but then also drilling a bit down how can blended finance be provide most leverage and be most effective. We will definitely come back to you. But now over to Leticia for her short input presentation.
Great. Hello, everyone. I think I'm lucky to be third because I can build on quite a lot of what the other panelists have said. So I'm Leticia Ferreras. I'm a portfolio manager in the development finance team at Allianz Global Investors. For a bit of context, at Allianz GI, we're an asset manager within the large Allianz insurance group that maybe many of you might be familiar with. Specifically, let me put this slide. Specifically, what we focus on in my team, what we focus on in the development finance team at Allianz Global Investors is essentially creating debt investment opportunities for the private capital to be catalyzed towards emerging markets in order to support the achievement of the UN Sustainable Development Goals, specifically in emerging markets. So I think building on what Chris Kaya was mentioning, we're all very familiar with the really significant funding gap that there is, especially in these markets, to achieve the SDGs and much more in the context of the 2030 deadline. So my team was created in order to be able to mobilize or attract private capital towards these markets, where traditionally there's been quite a lot of barriers to entry for various reasons, which I'll also touch on in a second. So I think the other panelists have talked a lot about the challenges of blended finance, and I think it's something that we'll continue discussing as well during the panel here. But I think maybe to provide some context, what we are essentially solving for in our strategies, or what's mainly, if I can say simply, deterring a lot of private capital from going into these markets, can be boiled down or can be principally reduced to the concept of risk or perception of risk, and then access and familiarity with these markets. So those are the two main things, and I say this simply, but it's quite a big challenge. Those are the two main things that we tackle when we're thinking about creating strategies in the development finance team at AGI. So on the one hand, when we think about risk, I think it's quite known to maybe all of you, but institutional investors have quite a significant balance sheet, especially when we look at insurers in Europe. We're talking about 8.7 trillion euros. So there is quite a lot of capital that in a way is ready to be mobilized. However, when we look at the breakdown of those of the investments that these type of institutions have, we actually see that about 70% of those go towards debt investments, which of course are less risky than equity, and about 98% of those are in investment grade, which what shows is essentially that there is very little diversification that goes into non-investment grade. And when we think about emerging markets, the median rating for emerging markets at the sovereign level is a single B. So there's quite a mismatch between what institutional investors are looking for in terms of risk appetite and the kind of risk they're willing to take, and then the kind of opportunities that are present in emerging markets, and especially when we talk about least developed countries. So in many cases, I'm aware that we talk about perception of risk versus actual risk, but the reality is that institutional investors are still, or many of them are still not quite ready to go into the riskier investments based on the kind of portfolio composition that they have. On the other hand, we talk about the lack of access, and I think this is driven by, in many cases, a lack of familiarity.
So just inform me, I don't know if you saw my message.
Sorry? Oh, never mind then. Apologies, I'll continue. So in terms of when we talk about access, it is a lack of familiarity with emerging markets, that perception that emerging markets are always riskier, a lack of knowledge of regulatory frameworks, how governments work, and also the lack of local presence, to be very honest. Many of these institutional investors don't have teams in most of sub-Saharan Africa, Latin America, the Caribbean, Asia. So that's also a part of what's driving the lack of investment there. Origination can be quite resource intensive. So that brings me to this slide that you see over here, that Venn diagram, which I think connects really well with that concept of cocktail mixing that we were speaking about earlier on, where we are really putting together all the forces and trying to align incentives among the private sector as well as the public sector, both on the multilateral side as well as the donor side. So the way we view it is when we think about that concept of risk and access that we're trying to address to catalyze scalable private capital, on the one hand, we work really closely with donors and philanthropic institutions to be able to help us with that de-risking. So the concept of first loss that some of my colleagues were talking about, first loss, whether that be in the form of guarantees on a single transaction at a fund level. We are talking about technical facilities in many cases, so we'll speak about the instruments a bit more in detail during the panel. But that's that helps de-risk that risk concept of perception of risk that many of our investors have. And on the other hand, we work really closely with development finance institutions, multilaterals, such as the IFC, which I'll talk about in a minute, that have that local presence, that have also been doing this for decades. So in terms of track record, we're familiar, we know that they are knowledgeable of the markets and they have the right boots on the ground to be able to have that access and familiarity with which many of our investors lack. So in terms of practical examples, I think both from the pitch and IFC perspective, they were given really good examples. At Allianz Global Investors, we've been involved in blended finance since 2015. And this started, our activities in blended finance started off as a result of a partnership specifically with the IFC as part of their managed co-lending portfolio program, which many of you might have heard, MCPP. So this cooperation started off in 2015. Where initially the thought was to create a structured fund that eventually led to an actual blended fund, where we combined capital from Allianz as our investor and parent company together with a first loss tranche from IFC. So that really catalyzed it is about 10%, which is disclosed publicly, as Kriskaya mentioned, about 10% of the vehicle was able to catalyze the remaining 90%. So when we think about leverage, it is very significant, especially when we talk about, we see other smaller blended funds or different structures where the leverage or the catalyzing power was smaller. So our focus is to really do this at a large scale. So this fund was initially about $500 million. And recently in COP26 last year, we announced that together with the IFC, Allianz announced that this fund was actually going to be doubled. So really highlighting the success of the vehicle and the partnership. And I think one of the important things that I think is worth highlighting, and many of our investors bring up to us, is that blended finance is really meant to be beneficial for all parties. So when we think about the actual impact, which is at the core what all the investors and all the parties involved in the fund is key. And I think we can talk quite a lot about impact measuring and reporting and how important that is to make sure that we can actually prove that we are making the impact that was originally intended. But equally, when we talk about the benefits to the public sector or the DFIs, donor agencies, there is room there to very much potentially generate return. I think when we talk about blended finance, it really encompasses so many structures and so many themes that it's hard to generalize. But from our perspective, how we structure our funds is we try to make these as sustainable as possible in terms of a solution that can be replicated. So from that perspective, we use funds from the public sector ideally on a non-concessional, meaning there is return to be generated for both parties. And from the private side in this particular vehicle, Allianz was able to, through that first loss, was able to get to a risk profile that was more in line with what they felt comfortable with. So I think that's a really good example of how blended finance has come to life and to work, and really on a very scalable basis. Because at the end of the day, I think, from my perspective, every dollar counts. But of course, when we talk about billions to trillions, it is important to ideally create structures that are at least in the billions and can continue to be replicated. So from our perspective, we've been, that was our first vehicle, and we've since created, we're on our sixth vehicle now, both on the debt and the fund of funds, equity fund of funds side. So we see blended finance as a very important part of what we do. I think we'll talk a little bit more about, whether it'll be forever needed and the concept of the silver bullet, which I think is also quite important. But I think for us right now, in an effort to mobilize as many private investors as we can, it is quite an essential solution. And I think we also need to think about, and something we discuss with our team quite a lot, going beyond when we talk about institutional investors. The most sophisticated ones are often the ones more ready to jump into blended finance, but there is a concept of market creation when it comes to attracting private investors that go beyond those really large, sophisticated insurance companies. Our idea is that blended finance and the idea of mobilizing private capital can go beyond not just these institutional investors, but going beyond into maybe smaller ones, as we hopefully try to simplify some of these structures. This is just our happy faces in the team. I think it's quite important to highlight that at Allianz GI, we actually have a dedicated team to development finance, which I think is very helpful when it comes to really providing the market with that confidence that we are in this, not just because blending is trending, which I think is very important, but really in this to create multiple solutions and continue growing as the market hopefully changes. So we'll leave it there.
Wonderful. Thank you, Leticia. And great to hear that you do get happy faces working in blended finance. Now, we have been talking for years about scaling up solutions, about growing it from the billions to the trillions. And this morning, it was quite interesting in one of the panels, Beatrice Weder Di Mauro said, what we really need to do is just do more of the same and grow it incrementally. But we all know we hope for really scaling solutions up. Now, I would like to dive a bit deeper on this. And actually, I think we should now somewhere see a QR code for our Slido, because I want you to get involved as well in the discussion. I'm sure we'll get the slide up. But in the meantime, I'd like to hear from Marco. I mean, infrastructure is probably one of the easier sectors when it comes to investing and to making investing economic, but then also investable. Where are the main limiting factors for Pitch in further scaling their investments? What is it that sort of inhibits you in speeding the scaling up?
So, I mean, defining infrastructure as one of the easiest sectors, I think, is a bit unfair to my colleagues and the entire sector. With the type of infrastructure that we put in place are the first of a kind, independent power producer, solar. It might be the technology, it might be the financing structure. But you're right, you've got the assets, so you should be able really to attract finance into that. The issue is the timeline. So what is missing is, once again, is that 10% capital that is binary and is very risky and very patient. It takes typically 6-7 years in order to develop an infrastructure project. Financiers, investors, if they can, they will go somewhere else. So what we need is more equity in the infrastructure space in emerging markets, and that is extremely rare and extremely difficult. One of the things that we're doing in order to one of the key things is leveraging local capital as well, including in local currency, and that is really important. And I think the experiences that we're seeing with guarantees and credit enhancement are really important for that, and we can hopefully talk a little bit about that. I'll just give an example. In some countries, banks cannot lend beyond 7 years. Because that is the yield curve that they've got available. And so what we will do is we would do something called the credit extension, liquidity extension guarantee, which effectively tells the bank, we're going to cover you for the following 8 years. And that allows us to match the finance to a 15-year project, because otherwise the finance for infrastructure doesn't stack up. So the challenge is it's long-term finance, and it's easy to refinance operational assets. The difficult part is to finance greenfield infrastructure, which is the big challenge in emerging markets.
Thank you for these insights. Leticia, maybe about your end, what keeps you off growing even faster with your team? Is it lack of people who have the know-how, or is it lack of co-investors?
Probably take the whole 30 minutes just for that. But I think, I mean, what keeps us from growing faster, and we're already growing quite fast, to be honest, I think, but what keeps us from growing faster is all the, in a way, the lack of availability of catalytic capital. I think there's quite a lot that is discussed on first loss, so I don't want to bore the audience, but I think it is quite important to understand that for blended finance to really be scalable and to talk about funds, as I mentioned, in the billions. We are funds in 50, 60, 100 million are super important, but ideally we want to create structures that are scalable. But when we talk about $1 billion, if you think about the amount of first loss or catalytic capital that is needed within that, it is quite significant. And it is also a challenge to be able to fundraise for this type of capital and for the kind of capital that is flexible enough. So I think one of the things that we speak about is that catalytic capital and sources, in many cases, are very patient. However, they're sometimes designed to be very specific in terms of the thematics or in terms of the countries they support. And sometimes that's a challenge when we think about creating a structure that is $1 billion that needs to be deployed. And then also, on the other hand, being able to fundraise for first loss that is only dedicated to one sector and have a continent, for example, because then the amount of volume that we need doesn't quite match the capital that is available. So I think that's probably one of the main things in terms of structuring the vehicles. I think ultimately we are talking about vehicles that tend to be quite highly structured, so they take a bit of time. And when I say a bit of time, it's at least a couple of years to be able to fundraise and structure these vehicles in a way that it aligns all incentives of both the public and the private sector. So from that perspective, I think that's probably one of the things that would be challenging. And I think Marco had mentioned earlier in terms of availability of projects, which I think he would probably have a good vision on, as well as Chris Kai at IFC. But that's also an important point for us, making sure that we are able to have enough pipeline to invest. And then maybe the last point on that is the availability of data. I think we also mentioned this in quite a lot of panels, but from an investor perspective, as you all might know, when you're fundraising, the idea of track record is essential, not so much us as an asset manager, which of course is important, but also the asset class. What's the track record of the asset class? How do we know that these vehicles are indeed robust? And I think at this stage, there isn't as much transparency as to how the track record, especially of development finance institutions, have been for the decades. So it sometimes gets a bit complicated to try to share that or to prove that to investors that are new to the asset class and haven't invested before.
Thank you for this. And now I'd like to combine a question that I've already received from the audience about the fact that the majority of blended finance solutions actually target lower, upper middle income countries. How can you actually move blended finance solutions to the more fragile environments? And maybe that's a question for you, Kruskaya. How do you make sure we also read the difficult frontier in this?
Thank you very much for the question, and I think we have been doing so, and it resonates, a couple of points that were made. The first is the availability of the relatively flexible funds. So in 2017, IFC was able to, receive access, as I had mentioned before, to, a private sector window established from the International Development Association, one of our sister organizations that focuses in the lowest income and fragile, countries. By having that available, we have been able to really move our deployment of blended finance into, the most difficult countries. So if I give you an example of the last 10 years, the first part of those 10 years, we probably were doing 125 million on average per year. if you take the last 5 years of those 10 years, we are doing on average about 500 million. So it's quite a step change of, the use of this catalytic capital. And this is because of the availability of flexible funding that allows us to take it, in different projects. It is not only one theme. It covers a lot of themes. It can be climate, gender, fragility, jobs and economic transformation. So it gives us that very broad scope for us to be able to do that. In contrast, and I think that this is very important to, to share as well, where we see a huge gap is in particular in the climate space for middle-income countries, so for projects in middle-income countries. The same time frame that I used for the other example, the last 10 years, there has been a constant around 70 million that we have invested in this blended finance, on climate, solutions. So, you see on one hand, we are growing very much, in particular in the low-income countries and fragiles because of the availability of this funding, while in climate, we continue to be there because we have a number of partnerships that allows us to, to go into, a more global perspective, but they are usually much more limited in terms of also thematic scope, and also, many more donor partners are interested in the low-income countries at this moment in time. So that big gap is being at this moment in time felt on the middle-income, countries. So a little bit of a contrast to the question that is there. Perhaps one additional point that I will make on data and why even the question comes as to why we're not doing more in the low-income countries is because many of the reports that you get tend to be a couple of years behind, so you don't get to see real time how we are moving towards more and more, projects and programs into the low-income fragile. Perhaps an important thing is the trade-off. The moment that you move into the lower income and fragile situations, you need more blending, you need additional concessionality. So it is not as simple, and also your leverage numbers go down because there is not as much appetite to go into some of these projects when there is a lot of complications around it. So I'll stop there.
Thank you so much. So less leverage when you go into more difficult environments, indeed a difficult trade-off. An interesting question also around a similar topic is the fact that there are NGOs that have local know-how and also donor agencies. And the question of someone from the audience is, how can especially the private side better cooperate with NGOs? You mentioned lack of local know-how that can be an issue. Have you worked with NGOs to tackle this?
So that is... there you go. That is a sector that we are very actively trying to engage more and more. I think more on the philanthropic side, both from a potentially assisting on the de-risking, because many of them, in this case, I'm talking more about the larger foundations, but many of them are able to raise the type of risky capital or patient catalyzing capital that we could also leverage for blended finance funds, but also very much to the point on NGOs. So, it is sometimes hard because the NGOs have, different sizes. In many cases, they're talking about, agriculture in a very specific country. So for us, it is very hard to engage, hundreds of NGOs to cover all the markets that we are involved in. But that is definitely a sector that we're trying to engage more of as we continue growing in blended finance and working, not only with the DFIs and multilaterals that are on the ground, but also, NGOs and philanthropic institutions that have a lot of sector expertise in certain places.
And maybe just a follow-up question on that. I've often heard that there are different languages spoken by NGOs and investors. In the contacts you had, did you make this experience? Is it difficult to build a bridge between the two?
I think that's probably the case for all the different parties involved in blended finance. I think we often joke on the kind of asset manager, the blended finance role, that we're a bit of the interpreters/translators between, on the one hand, the public sector speaking about donors and development agencies, the DFIs, multilaterals, the private sector, and very much the NGOs as well. I think it's that concept of trying to align incentives. Everyone has a slightly different way of doing things and different drivers, but ultimately with overall the same goal of creating positive impact. So yes, I very much agree that that concept of speaking different languages is a role, but I think that's always the case when you're combining different players. So it's a challenge, but not one that we don't deal with already, I would say.
So hopefully building bridges also contributes to finding this common language. A question that is maybe out of curiosity, and I'll direct it to you. Who are other traditional asset managers that have developed blended initiatives? Who are your other partners from the private side?
So from the private side, so there are not many. That's the first thing I'd like to say. So initially, the first investors in pitch from the private side were Allianz and Standard Chartered Bank. I think now, on the back of the current rating, we're seeing a very different interest from a larger pool. I think that's an important, that's an important element. If I may add just one point on the previous question, if I can, just a data point. Our investments, on average, are 50% smaller in least developed countries than there are in lower middle-income countries. So
How many percent?
They're half.
Half, 50% smaller.
So that gives you a sense. Obviously, then it becomes more difficult to aggregate, etc. And they also take longer. So I think that, picking the right projects, knowing that probably you're going to have a change of government and a change of regime and a coup is really difficult. I mean, we're talking of, we're involved with others in the first independent power producer in Chad, and that's been a journey. And we're still there. You need to be there for the long term. Concessional capital is absolutely essential. There's no way we can do it without.
Maybe another follow-up question on size. I mean, we've seen the examples of Kruzkaya. Investment ticket size and de-risking mechanisms are usually for projects of around 20 million or smaller. How can such financing mechanisms be made accessible for even smaller projects?
Can I, maybe if I can start? So I think that ticket size is that's probably our, on the debt side is true. But we are investing in things, we're doing another type of investment, which is much smaller, which is, for example, working on with mini grid providers, so off-grid energy. That goes to a much lower level. We would invest even, between 2 and 5 million to start with, and that is the first capital that company will get behaving like private capital, even if we are bringing in public capital in, and then work with them. And the same has been with investments like electric mobility, which we've done a couple in Africa as well. It's really key to go in at a lower level, and blended finance is happening also at that level. But it's happening deal by deal, and that makes it very difficult. What we need is platforms that blend at the platform level and then allow these deals to develop.
If I may, add, a couple of words there. I think that, working through domestic financial institutions has been another great way to ensure that, they can go to a smaller level. So we partner with a number of our, financial institution clients to do that, especially on the SME finance space. In some cases, with funded structuring, many spaces with risk-sharing facilities that allows actually the capital to go also on local currency, which is really great. And then more on the equity side, we have been working with, first-time tank managers, also, going relatively small with, basically risk capital being, given to small SMEs. We wouldn't be able to do that, ourselves, but if we work with our, fund manager clients, that's another way, to do it. So there is quite a lot of these partnerships and clients that, will allow us to reach, much smaller ticket size, through them.
Thank you for this. And then another actually very topical question, the whole question around foreign exchange volatility. We've seen so much volatility in foreign exchange rates. How do you go about hedging this? And how does this make your life more difficult, or has been making it more difficult recently?
Yeah, please. Go ahead.
It's a fundamental part of the mix. So the revenues are in local currency. The macroeconomics are deteriorating even further with the debt crisis. Leveraging local currency is essential for two reasons. One, there's not enough private capital flowing to these markets, and there are pots there in in countries like Nigeria, in the pension funds, etc. And the second is that the cash flow of the projects mean that you need that local currency. So it's part of the DNA of what we're doing. We've used guarantees to bring to the market the first local currency commercially issued bond in Vietnam, and the interesting thing is that there was as a green bond for renewable energy. The interesting thing was that the level of guarantee that we had, that was the first certified green bond, but also the third bond in the country. The interesting thing is that the level of guarantee that we had to issue went down from 100%, then 75%, then 66% in the last one, with the same pool of investor. So success does breed success in this type of solutions. And the second one is building local capacity. So 2016-17, we've set up together with others InfraCredit Nigeria, which is a local credit enhancement guarantees that brings in local pension funds into infrastructure projects. And they did the first 10-year bond, the first 15-year bond, the first 20-year bond in the country. We've replicated that in Pakistan. We hope to replicate that in other countries. I think that's important.
Very interesting that you also build up the local capacities. Kruskaya, how is IFC dealing with the increasing foreign exchange volatility?
So I think, when there are swap markets, even on the blended finance side, we have a solution that, we use basically a credit pass-through swap to try to ensure that we are helping our, projects, client projects, to match the revenues with the local currency, but effectively that's a very partial solution, because in many markets, especially for long tenors, you won't find that. So then the other facility that we have, and this is again for lowest income countries and fragile situations, is a local currency facility that is a part of this either private sector facility that we have. There effectively we either look for solutions that are quasi-market, partnering quite a bit also with TCX, for example, to try to find basically possibilities there, or ultimately take unhedged risk, but again a very risky proposition and still very, very partial in terms of the solution that we need to to use. So I guess like everyone else, we are trying to just complement the solutions, but it's still a work in progress, I will say, on the FX.
Thank you for this, but I would like to follow up. We all know hedging comes at a cost. What are the average hedging costs you have for your portfolios? Maybe also to you, Leticia.
Yeah, I mean, I'll say, to be honest, the blended finance funds that we have structured to date are hard currency denominated, because the complexity when we're talking about crowding in private investors, especially those that are new to blended finance, if we start combining already the complexities of emerging markets and on top of that adding that concept of FX, I think it's a very good point that hedging costs, I wouldn't be able to tell you an average, but it is quite high. When we're speaking about a debt fund, when you're talking about senior debt, in terms of the returns that the loans themselves are generating, when we talk about reducing those by hedging costs, it just becomes economically unattractive for our investors. So I think that's been quite a challenge for us, especially when we talk about it at a fund level, instead of an individual transactions, as Kruskaya was mentioning. I think at a fund level, it is quite a challenge to do that. I know that there's been structures put in place where first loss is specifically dedicated to currency devaluation. But that's only adding yet another level of complexity, where you have first loss covering for credit risk and first loss covering for FX, and you start building from there, and becomes quite big structures. So from our side, I would say the only hedging that we do is the fact that we invest for a lot of euro clients or European countries, where European clients that prefer euro denominated, and if it's dollar, but that's hardly the hedges that we're talking about here. Yeah.
And maybe a few questions on the further development of this market from a different perspective. First, blockchain, a buzzword. Have you seen blockchain solutions that make blended finance easier, or maybe provides more transparency? I see long faces on the panel here who would want to...
Yeah, not yet.
I guess not yet is my answer as well.
Not yet.
I think the idea of increased transparency and data points is and integrity of data is well, resonates, but I think, yeah, not yet from my perspective.
So hopefully
there's a gap there.
An opportunity for the future. Now, someone in the audience thinks that one of the barriers is not just maybe lack of co-investors, but also not enough service providers, transaction banks, even custodians that are willing to work in these segments. Have you experienced it as being difficult to find the right partners here? Do we need to see such markets develop further, or will it come with the growth of blended finance solutions?
I think the key thing that we need is rule of law in the countries in which we are investing, so that we know that the contracts can be enforced. The services develop around that, and we need local services. But there's never been transactions on our side not going through because of the lack of services. It's more that the ecosystem is so complex that it brings on extra costs, and investors and developers and capital tend to go somewhere else as a result.
And I think to build on that is that concept, I mean, definitely on the rule of law, but also a lot of the service providers that we work with and we see in transactions are international commercial banks, for example. So I think to that extent, they're very much active in many of the countries where we see transactions, but it is really more about focusing on building that local know-how and that local expertise, which we rarely see local service providers for this type of roles.
What about you, Kruskaya?
Yeah, I very much resonate the answers. I mean, I think there is a lot of work that we do and we need to do upstream to try to make sure that the enabling environment is in place. As it was mentioned, that there is clarity in the contracts and what is need to be done. Once those conditions are there and there is capacity building and working closely with potential sponsors to develop projects, I don't think that I have seen at least it mentioned that lack of service providers has been a constraint, but because as you move the whole ecosystem into something that is more stable, probably that you have also partners coming on the service side to provide that. So I have not seen it as a constraint.
Thank you for this. Well, with that, I would like to come to a last round and ask you, what would be your wish to your respective partners in helping you to further grow your business? I start with you, Laetitia.
I think one of the points that I wanted to mention, and it kind of builds on what Marco was mentioning about the recent rating for the Emerging Africa Infra Fund, is, and not to continue putting the point on data transparency, but I think it goes to an example of an A2 rating from Moody's attracting more investors into this space. I think it's a very, very important message to the overall blended finance sphere and parties, because a lot of what we see and we bump into is investors that are very keen to go into blended finance, that they're very excited about the concept of impact, sustainability. There's continuous commitments of capital towards this field, if I can call it like that. But ultimately, there's a lot of constraint in moving capital towards investments that don't have a rating, where the track record isn't transparent. So it's almost a bit of a vote of confidence or leap of faith for many of these investors to try to understand how this asset would develop. So I think it goes to show that blended funds that already have a track record and have managed to achieve that rating, it really is a game changer for this industry. So when we talk about catalyzing and moving billions to trillions, as we like to say, I think these type of things and more practical financial considerations sometimes is very important, especially when this is what investors speak like. This is what we need to tell them and how we need to convince them.
And Kruzkaya, what would be your wish to your private partners?
I think, again, probably not only to the private partners, because I think on the private partners is really working alongside to see how we, help, build that pipeline of, private sector projects that can be then financed. But if I take, the broader, partners, I think, to the contributors, this idea that, more flexibility and clarity and quantum in terms of, resources is very, very much needed. And perhaps, to the entire ecosystem, adding it's not only the data that I think is necessary, but also the transparency on the use of concessionality. I mean, we cannot tell, the ecosystem that, we are going to move towards commercial sustainability if we don't show that in initial transactions, we need to take some concessionality, that not everyone is getting fully compensated for the risk that is taken, but in subsequent transactions, you move, closer to commercial sustainability. So that transparency in terms of, the subsidy being used, I think is quite important as well from the IFC perspective.
Thank you, Kruzkaya. So the last word goes to Marco.
I think we do have the instruments. We do need to scale up the solutions that work. So similar to the message that you gave before. I think the key message to partners that I would give is let's have a serious conversation about how do we scale up the project development piece and the equity piece, because without that, and bringing in the local currency financing as well at the local level, because that is the way to be counter-cyclical compared to the current flows, and that is the way to create the pipeline that will bring us to scale up.
Thank you very much. And please join me in thanking the panelists for their insights that they shared with us.
Thank you.
And with that, I have the pleasure to hand over to Laura Hemrica to moderate the second part of this event, all around the SDG Impact Finance Initiative. Bye, Kruzkaya, and thanks for having been with us.
Thank you. Our pleasure. Thank you.
Good afternoon, everybody. My name is Laura Hemrica. I'm the Global Head of Corporate Citizenship and Foundations at Credit Suisse and the Managing Director of the Credit Suisse Foundation. And I'm delighted to take you on the journey in the second half of today's session. So thank you, Sabine, for a great first half. And as first step, I'm actually going to welcome someone else onto the stage, and that is Ambassador Christian Frutiger from SDC.
Thank you. Thank you very much, Laura, and hello, everybody. It is an important moment, right? We're back here in Geneva. We've heard over the last couple of days that the world is in crisis. It is difficult. The earth is warming. We're running out of food. We're running out of water. We're running out of land. We're running out of peace, actually. So it's high time to do things differently. And it was really encouraging to hear in the various discussions today and also just now that things can be done differently, and that we can reach scale and be successful with blended finance, even in low-income countries. So I'm very happy to be here now and to start the second part of this session today, which is about a new initiative, a new blended finance initiative jointly undertaken by the foundations of UBS, Credit Suisse, SECO, and the Swiss Development Agency from the public sector side, the two other players from the private sector side. I'm convinced that over the last 2 years, we have laid together a solid basis for this new initiative, which will provide much-needed blended finance for smaller as well as scalable projects targeting the SDGs. And it will also work on improving the framework conditions and the regulatory framework for impact financing. The SDG Impact Finance Initiative, or short SIFI, strives to invest 1 billion Swiss francs towards the achievement of the SDGs until 2030. Since the last Building Bridges Week, a year ago, considerable progress has been made since we launched formally the initiative. Let me just mention a few accomplishments. With the organizational structure and governance of SIFI has been established with the conclusion of its Articles of Association. We are ready to take off. With the organizational structure in place, I'm glad to introduce to you today the new independent executive president of SIFI, Ms. Josiane Sluis. Josiane has an impressive curriculum, and we are happy to have her on board for SIFI, and we really look forward to you leading this future endeavor. I'd like to congratulate and welcome Josiane in your new function, and I really look forward to hear from you in a few minutes about where you will take the organization. Then, in terms of funding, I'm gladly informing you all that the Swiss Development Agency, SDC, has formally also approved its funding for SIFI, amounting to just under 6 million Swiss francs. By doing so, the Swiss public sector, together with the funding of SECO, approved a considerable envelope of 25.3 million Swiss francs to get SIFI launched. This significant initial funding from the Swiss public sector serves to illustrate the commitment towards this new and innovative facility to address urgent financing needs of the present, with a view to catalyze major resources from the private sector for the future. I take your presence in this room, as well as the volume of submissions to SIFI's initial opening call, as a signal in the right direction. And I look very much forward to the discussion about where the SIFI journey will take us next. I also look forward to working with you all in making this journey successful. It's the moment to start doing things differently. It's the moment to reach scale. We've heard we need more de-risking, we need more catalytic funding, we need governments leading the way, and the private sector funds will crowd in. So we have started doing our bit. We will attract other public donors, but then we also want to see the private sector funds crowd in. So let's do things differently, let's do them fast, let's start now, and let's reach scale before we run out of time. Thank you very much, and with that, back to you, Laura.
Thank you very much, Ambassador, for those opening words and for confirming that SDC commitment, which is simply fantastic. A few more updates from me. Those of you who were here last year will remember the launch of the SDG Impact Finance Initiative. very much with the mission to advance measurable progress in developing countries towards more capital invested in the SDGs. And with that, new capital solutions, and especially innovative finance solutions that are the result of innovative private-public collaboration and partners. 100 million is what we are seeking to raise, 100 million philanthropic capital to unlock up to 1 billion in private investment towards the SDGs by, indeed, before we run out, but definitely by 2030. How are we going to do that? Yep. We've really got three main areas of activity. First of all, we want to support the design and development of innovative financial solutions. And so that's really at the earlier stages. We're talking about grant capital for design funding, proof of concepts, and so forth. Enhancing collaboration amongst actors. The second area of work is really to scale in mainstream impact investment solutions. And so there, again, looking at technical assistance for investees, looking at first loss guarantees, seed funding, and other manners of intervention to support impact investment products that are out there. And then finally, the third piece, or third area of work, is really around the environment, the framework conditions, raising awareness, strengthening the ecosystem, and bringing together the community. Now, admittedly, in the last 10 months, we have not done all of that. We've done a lot, I think, and we'll talk a little bit more about that in a second. And we've continued to listen, to learn throughout the last 10 months. It's particularly important to us to give you this update today, 10 months after launch, because we were launched here at Building Bridges, and because so many people in Switzerland and beyond, but especially here in Switzerland, have been part of the birth of the SDG Impact Finance Initiative, and then also the further development. And we hope we continue to hear from everybody, not just today at the drinks and during the questions, which you'll be able to access through the QR code, but as we go on in the next months, because there's a lot more to do. But what have we done? You've just heard, thanks to the commitment from SDC, we have now raised over 30 million towards the initiative. We have a very highly collaborative, fine-tuned team of experts and leaders from all the founding partners who have been working together very diligently behind the scenes to set up the organization. Some very exciting strategic conversations and some very hands-on, more technical things that have to be done. We have our new brand, which you can see in the corner here, which we are launching today as well, which is exciting because it helps us build a further visibility and awareness, which has already done very well. It's great to hear how much people actually know about the initiative already. And we've been working together with our partners to set up our processes, to set up our systems, and to, most importantly, get going. As Ambassador Friedrich already mentioned, we're delighted to welcome Josine Sluis as the independent executive president of the initiative. Josine is the managing director of Aqua for All, which is focused on water and sanitation, and especially focused on innovative finance solutions in that space. She also brings with her extensive experience in being on the board of multiple impact investment funds and other industry initiatives. So we'll be hearing a little bit more from Josine. Josine, we're delighted you're here, so welcome. Finally, let's get going on our on the most concrete piece and the most visible piece of our work this year, which has been the launch of our first call for proposals. It was important for us to get going and to have tangible, pragmatic outputs to the initiative. And so we launched a call for proposals towards the end of the spring, early summer, for our first window of work, in the innovation window, which is focused on design funding, proof of concept proposals, and proposals focused on the expansion of impact investment products. Now, remember, there are two other windows, and those will be following. We'll be hearing more about those in the months to come as well. But here we wanted to focus on these, and especially on a call which was focused on 4 SDGs, SDG 4, 8, 12, and 13. And so today, at the end of this session, we'll be announcing the finalists for this first call. It was very competitive, and we look forward to sharing that list with you. And that'll be Josine's pleasure as one of her first acts as president. So, without further ado, and in order to get a little more concrete and share some of the insights and learnings of our first year together, I'm going to welcome my fellow panelists today, starting with Maya Zisweiler, CEO of the UBS Optimus Foundation, Liliana de Saa-Kirchnopf, Head of Private Sector Development at SECO, and Chris Clubb, Managing Director of Convergence Blended Finance, who, together with his team, has led us through this first call for proposals. Now, we'll have a bit of a fireside chat, and then during that time, you can also put in questions through the QR code that you see right there. And I think I have to sit in that far seat, Maya. Wonderful, thank you. After that little real estate reassignment, thank you very much. It's wonderful to have you all here today, and I'm going to kick off straight away with our very first question, which is actually directed at Liliana and Maya as not just founders of the SDG Impact Finance Initiative, but also as funders of this first call, which was a fantastic first step for the initiative. So let me just kick off with the question to you, Liliana, about, what was your motivation in funding this call in particular, focused on these 4 SDGs?
Well, good afternoon. Good afternoon, and it's a pleasure to be here, especially as was mentioned that we launched the SDG Impact Finance Initiative last year at Building Bridges. And let me just take you a few steps back, because at the very first edition of Building Bridges, there was a declaration by the impact investing community in Switzerland calling upon the Swiss authorities that we should utilize the knowledge and the actors in Switzerland to further strengthen impact investing for the SDGs and for the developing countries. And so given SECO's experience in this space for more than 20 years, and since we had piloted a first open call for proposal called SECO 17 in 2017, we envisaged, or we took this call for action very seriously, and we said, okay, let's actually sit together, bring together the actors, and co-create something. And this something was then the SDG Impact Finance Initiative. It was really a co-creation process with many, many actors. That's why it also took a bit time. But we're actually glad that it was a mature and creative process, because we really could create something comprehensive with these 3 windows. And also reacting on what we often hear is that it's a fragmented market. And we wanted to do something about avoiding further fragmentation, but on the contrary, bringing the forces together. So then on the first open call for proposal, I think someone before mentioned, let's not add too many complexities at once, right? So we added complexity compared to the SECO 17 call, because we have these 3 windows. But we said, let's focus in terms of SDGs that we want to select to get going. And we were looking at some of the priorities of the respective founding members. And so we came up with these 4 SDGs. Some are already quite well funded, others less. And we'll hear a bit more about that.
Yeah, absolutely. And same question to you, Maya, coming in from the UBS Optimus Foundation. What drove you towards being the first call funder?
Thank you. I'll also just take a step back and give a little bit of background of why we were motivated to join the SDG Impact Finance Initiative. I think a key motivation is around obviously attracting more private sector capital for impact to help reach the SDGs, but really also to help bridge the gap between the philanthropic funding that we can provide and getting to mainstream private capital. And this was mentioned in previous conversations, but it's about addressing the risk, but also risk perception, as well as providing access to investable opportunities. And ultimately, what drives us, and this is linked to, thank you, and this is linked to our thematic priority areas, it's about making sure that there's access to high-quality healthcare in rural India. It's about making sure that there's increased livelihoods and building climate resilience in Indonesia. And it's ultimately about making sure that children that weren't able to access education because of Ebola, because of COVID, can actually start learning again. So that's ultimately our motivation. But it's also core to Optimus's ambition of building a thriving impact economy. And we really leverage 3 pillars, which is around early stage seed funding, whether that's grant or investments through impact ventures, but it's about scaling that through partnerships with governments and multilaterals, but also partnerships through blended finance. And underpinning it all, and we'll come back to that later, is this concept of impact transparency. So maybe coming back to why this specific call, we heard it now many, many times also in the previous panel, the need for catalytic capital to get to scale. So why do we fund this is because we feel like there's more of that catalytic capital that is needed. I think what we're hopefully trying to achieve is to plug that gap, but also being recognized as an enabler and an important partner in that impact ecosystem. And as Liliana mentioned, we engaged with a lot of you, and we're hoping actually to get some more interested parties and partners to join us on this journey, on this basically public-private partnership that is needed in order to unlock more catalytic capital.
Great. Okay, so we have the theory. Now let's get to the numbers. And Chris, I'm looking at you. What our audience will see above us is an overview of the results of the call for proposals. Now, you were telling me earlier today about 160 expressions of interest, which led to nearly 80 proposals actually being submitted. We said it was competitive, and indeed it was. What we can also see up here is that the feasibility studies, of course, were one of the key area of interest. On the SDGs, a pretty good spread across the SDGs, but especially also a focus on decent work, perhaps not too surprisingly, and then climate action. So education and responsible consumers and production, a little bit lagging, perhaps also not a surprise, and we're going to get your take and the panelists' take on that as well. And then, now, in case everyone's doing the math on these, they don't all add up to 100 because several of the solutions targeted several SDGs. And then we've got, so looking at the targeted regions, sub-Saharan Africa, very much part of the equation here, which is exciting to see as well, since we have very much a developing markets focus as well. So 80 proposals and these kind of numbers, what does that tell you, Chris? What are some of the takeaways you had from this process?
Sure, I'll reflect upon that. But before I want to do that, I really want to congratulate Seiko, SDC, UBS, and Credit Suisse. You know, my job is blended finance, and my job is to mobilize more investment into low and middle income countries. But arguably, the two biggest missing components is the lack of catalytic capital, as Maya mentioned, and then the fragmentation of that catalytic capital. Bringing 4 groups together, and maybe a 5th and a 6th, is definitely the way forward. Whatever catalytic capital that is available to mobilize private investment needs to be done in a collaborative way. Teaming up is the best route forward. I'll give you an example. There's around $410 trillion of global financial assets held by the private sector. but only 4.5% of it is in low and middle income countries. Many of those asset managers and asset owners have said what will be required to mobilize their investment. All groups say the same thing. Catalytic capital needs to be more of it and needs to be coordinated. So I really applaud our Swiss colleagues in bringing this all together, because that's the key to move forward. Now, reflecting upon the observations, what I would say is you're absolutely right. We were really very pleasantly surprised by the level of engagement we had across the board in developed and developing countries, from asset managers, from investors, from project sponsors. As you're right, we had 158 approaches. That translated into 76 written proposals. And I've got 6 observations here. Number one is the power of competition and communication. The 4 funders have actually created this competitive environment, very transparent as to what they're looking to achieve on a website. Now, beyond that, we have actively gone out around the world to communicate this program, and we've had serious uptake, resulting in 76. Now, it's due to competition, brilliant competition to evaluate and assess all these, but it needs to be, we were very, very good at communicating that globally to get that done. The second observation is clearly, as our colleagues from the private sector just mentioned earlier, there's a huge demand for design funding grants and catalytic funding, as witnessed here. The third observation is that there is a huge spectrum of organizations seeking this catalytic funding. We had small little individual shops located in an individual developing country, all the way to some relatively significant asset managers located in Europe. There's a great breadth of organizations requesting the funding, demonstrating a huge appetite across the board for all of those that are involved in innovative finance. You're right, when we look here at the spectrum of distribution in general, when you look at blended finance and innovative finance, the funding flows to those projects and sectors where there's revenues, and witness SDG 8 and SDG 13, climate action. But we were very pleasantly surprised by the number have actually gone into education. So it demonstrates that if properly targeted and properly designed, we can be mobilizing private investment into many of the SDGs, indeed SDGs that have been systemically underfunded, possibly like education and healthcare. And really, in evaluating this, and as we announced the 7 shortlisted entities earlier, it's this whole idea of what we see at Convergence as a 2-tier approach. The 4 funders here and Convergence are really keen to be supporting 2 types of blended finance or innovative finance solutions. Number one, scale. Scale is very important. We've got a $4.5 trillion investment need, a $3.5 trillion investment gap. We need to be putting some solutions in the scale. But the funders are also keen to support innovation without the obligation to pursue scale. And we have a good juxtaposition or dichotomy here between the actual 7 shortlisted ones. And the last thing I would mention, and it really goes back to what our colleagues were saying earlier from the private sector, and Letitia in particular, many of these innovative finance solutions are great, but they're ultimately going to low and middle income countries. And investors in general are apprehensive and don't know low and middle income countries well. And what they do see is risk. For example, there's 141 low and middle income countries out there. The median sovereign risk rating is B-. Therefore, many of these innovative finance solutions will ultimately require somebody to be providing some catalytic capital in a risk-sharing way. And it's great that there's a competition to identify the best innovative finance solutions and which ones will require catalytic capital to mobilize the investor, and then what's the next phase thereafter. So those are my 6 observations.
Thank you very much. That's very helpful and resonates again. I think we heard earlier, right? The risk profile perception, and then also, as we were saying, there's several areas of work for the initiative, and this is just the first piece when it comes to design funding and getting out of the gate and getting more potential investment vehicles out there, so that we can then take the next step and see how we can support further on that front. So building on what Chris just shared with us, maybe Liliana and Maya, from your perspective, are there any observations that stand out from these numbers and from this process?
Yeah, well, first of all, I think we were very pleased to see that there was such high demand, but also that there is capacity out there. I think that's really a very pleasant surprise. I think where we're probably a little bit less surprised is to see that, you know, the proportion of applications and successful applications in the education sector is a little bit lower. But I think one of the objectives that we're trying to achieve is to make sure that CFI targets those SDG areas that are more difficult, where there is less investment. And we know that from data from the Global Impact Investment Network that the proportion of investment that goes to education is lower. So I think what we're really trying to do with the SDG Impact Finance Initiative is not only neglected SDGs, but also looking at more difficult geographies. So that's certainly, and seeing that sub-Saharan Africa is overly represented is also a pleasant surprise. But maybe building on that, I think what we're really seeing is that there's a need for different solutions for different areas. So looking at, and realizing that it's not a one-size-fits-all is really critical. So making sure that we come at it from different angles with different options to ultimately find solutions. So that push for innovation is critical. And maybe giving some examples of the work that we've done at Optimus in the education space, where we've looked at, you know, impact carries in education funds, so incentivizing a focus on impact in education, looking at leveraging outcome contracts where to make the education sector more investable, but also ranging to equity investments or education prizes, for example, in the tertiary sector. So really finding those innovative solutions, ultimately all with the aim of improving learning for children is really critical.
And before I get to the same question to you, Liliana, Chris, we just heard from Maya, you know, that there needs to be a slightly more nuanced approach. How did that reflect in your work in this call when it came to some of the more difficult SDGs, and make sure that we didn't only have one SDG for the proposals?
Yeah, so convergence, we can engage along the lines of our funders, right? If our funder just really wanted us to pursue climate mitigation, that's fine. But at the end of the day, the funders wanted to attract all 4 SDGs, and we got great distribution of proposals, and then we were able to assess each of them relative to the SDG that they're pursuing. So our expectations of a proposal for climate mitigation would be a lot different than education. And as a result of there being fewer proposals for education in general, we are looking for the best ones for education to be actually funded. So, you know, there might be a little more risks for those segments and those sectors which have been systemically underfunded by blended finance going forward, but the funders were prepared to accept that risk.
Absolutely. And then you also went through a process of really looking for those education actors and to see where...
Yeah, that's a great example. So in general, you know, we have a database of around 700 blended finance transactions. Very few of them have been for education. So we had to take a very strategic approach with tactics to get the word out to the education sector globally that CFI exists. They're looking for education proposals, and then we had to, in fairness, walk hand in hand with a lot of those that were looking to make a proposal for education, because they really haven't been making proposals for blended finance. They're usually going to a grantor to get traditional grants. So we had to walk them through the process of what is blended finance and so on. So very curated for that particular SDG.
And also a good example of where all the partners come together and the value of having so many partners in the initiative who can also tap into their knowledge and their experience and their networks.
And maybe just adding a thought to there, I think basically what CFI is trying to do is trying to correct for market failures. So what you were saying around building organizational capacity is a critical part of what the initiative is trying to do as well.
Absolutely. And Liliana, from your perspective, after this first call, shock, surprise, any other observations?
Actually very pleasantly surprised as well about the turnover. And again, comparing to what we did 5 years before, there was much higher interest and much more proposals. So I think that's great. I think it reflects also how the market has further developed, first of all, but it's also the force of joining forces and the networks, and having a platform like Building Bridges is actually great to get out the word and to reach out. The second point that surprised me most, and I think that's also a very positive result, is that almost half of the proposals came from developing countries. When we launched the open call for proposal 2017, we had 0 proposals from developing countries. I think that's a pretty impressive turnover. It shows the interest. It shows that we actually have a network and the interest and a voice to reach out to the ground, because that's exactly what Maya mentioned. At the end, we need local solutions, but we need both. We need the local solutions and the capacity for maybe already some tested structures that can be deployed. So this bringing this together is I think very powerful.
Thank you. But you started alluding to it, Maya, already a little bit in your answer of having to do more, right? Because there are more difficult sectors to finance and to fund, and that's one of the things that this initiative really aims to do. Difficult countries, difficult sectors, or underfunded, shall we say, sectors and countries. So what can we do as an industry, but then especially as an initiative? What can we do to address those challenges from your perspective?
I mean, I think it's around making sure that we address some of those market failures. So as an initiative, trying to build organizational and institutional capacity, trying to also, on the other hand, and this is the third window that you mentioned, is trying to improve the market framework and the conditions. So that's around regulatory, legal incentives, policy pieces. I think that's a key role for the initiative as well. I think in terms of what we want to do also next is to try and work more broadly with the ecosystem here in Switzerland and beyond, so that we can all identify together what are some of the bottlenecks that need to be addressed. So we are 4 partners initially, but it's about making sure that we are connected as an ecosystem and we listen to what some of the barriers are. And I think what we've been hearing is it's really also that impact measurement and impact transparency piece that could be an area of focus for the initiative going forward.
And Chris, you coming from a perspective outside of Switzerland and your experience in having run several calls like this within the convergence context, what would you recommend that we look at when it comes to addressing some of those challenges?
Well, first and foremost, I think we're big believers in this whole idea of competition. Therefore, when SIFI moves forward with the other activities, thinking about what you want to achieve, let's get the word out globally. As Liliana said, we're very pleasantly surprised to have half the proposals coming from developing countries. That's a great big issue. And then second is really the diversification of the portfolio. I think that there is clearly an ambition to be mobilizing at scale, but also keeping that appetite up for, okay, there's going to be some smaller innovative ideas that really need to be supported, especially if they can be replicated in multiple countries. So I think really the combination of the 2 philanthropic foundations, SDC, that's got a great name and a great focus in low-income countries, and SECO in a little higher-income countries, it's a great mix of collaborators to come together, and we're really looking forward to seeing the progress of SIFI.
Thank you. And Liliana, from your perspective, where do you challenge the initiative to address the challenges and to support this ecosystem further?
So I think we, under the window 3, the ecosystem window, we really want, as now So at the beginning, we really had to get things going, right? I had this morning an interview with a journalist, and then he said, well, you announced this initiative great last year, and then we didn't hear anything back from you. I said, yes, we were working. So that now that we're up and running, we can start actually to, in a more structured way. Now we have the structure, we had an independent president. We can, in a more structured way, reach out and continue the dialogue with all the stakeholders, because we need to coordinate very closely how we can position Switzerland, where we have still gaps, where we need to harmonize and align the impact measurement methods and so on. So that's definitely a priority. And then as we move from window 1 to the window 2 next year, we will really need to look at this scaling question and bringing in institutional investors. I mean, otherwise we're not moving the needle, and that's really where we need to put the focus.
A tough nut to crack, but luckily we have some people to speak to from the earlier session as well. And I hope you invited AGFI to come listen to the results of our first year of work. Good. Let me switch now to some of the questions from the audience. So I encourage you to scan the code if you haven't already and you'd like to submit some questions. So let's see. There's one easy question which I'll answer for the sake of expediency, which is if we can clarify our goal for the initiative for 2030 in terms of amount, 100 million francs or 1 billion. So it's 100 million of philanthropic capital to fund this work that we've been describing here, so that 1 billion in private capital can be invested into the SDGs in developing markets. So I think that's maybe not so much a panel question, but what are the characteristics of proposals that you observed as being most successful in this window specifically? And maybe, Chris, that's a good question for you.
Yeah, sure. So to reiterate, we had 76 proposals, written proposals. We had even more expressions of interest. And if we were to try and cluster, I've got 6 observations there. First and foremost, we spent a lot of time at the outset of this call for proposals to transparently communicate to the market, this is what the assessment criteria will actually be. So for those proposals that were successful, they mapped very, very well to the assessment criteria because it was very analytical at the end of the day. All of these proposals were assessed a number between 1 and 1,000, I think it was, and that was directly related to the assessment criteria. Number 2 is, you know, development impact and climate impact means different things. We were looking for really strong development impact and climate impact metrics that can be pursued that aren't just necessarily an output, but are actually potentially transformational. Therefore, those that are pursuing strong development and climate impact metrics that are seen as being maybe transformational would be valued or weighted higher. The third observation is really what we see as strong financial additionality. 2 types of financial additionality. Number 1, is there a need for SIFI to be funding this particular project, or can this particular project be successful without? So that's kind of SIFI financial additionality. And secondly, financial additionality of the funding in the developing country itself. You know, are you providing a level of financial additionality in the investment that you intend to make that is systemically underprovided in the market? You know, we just heard Pidge talk about local currency and equity versus hard currency debt as an example. The fourth is likelihood of achieving financial close. That takes a level of expertise to gauge, but for example, Convergence has been at this for 6 years. We've become pretty good at having a good feel as to whether or not a transaction will achieve financial close. That's not just us. To assess that, we reach out to others who know the market very well, that we're very close with, because a lot of good examples, a lot of good cases, if it's really weak on the financial close side, the likelihood of achieving financial close, it's just not something we'd want to fund. Fifth was scale. You know, not all of them, but those that actually were pursuing the possibility of mobilizing investment at scale, would get a high weighting. And then the sixth, if you're not pursuing scale, especially the ability for it to be replicated in different markets, different geographies, different SDGs. So those are the six kind of themes that would allow an individual proposal to be weighted higher than its competition.
Any additional comments, Maya or Liliana, on that point? But very much also looking at a portfolio of solutions, as you said, right? Especially when we're looking at multiple SDGs in a call like this, then also looking at, okay, of the proposals that we're going to fund, how do we get the right, or a good mix, let's say, of different approaches, different types, and so forth. And of the kind of vehicles that were proposed, what's your sense there? Did you feel that was representative of what you see out in the sector?
Yeah, so one of the challenges we have out in the blended finance sector, the innovative finance sector, is that so blended finance in many respects can be simplified in the following two ways. Everyone says there isn't a large enough universe of quote-unquote commercially bankable projects. So we can introduce a blended finance solution or an innovative finance solution at a project level to get, let's say, an independent power project to move from commercially unbankable to commercially bankable. That's great. That is putting a lot of time and energy into individual projects. But ultimately, now we create a lot of commercially bankable projects that happen to be residing in relatively high-risk countries. Okay? We can create a lot of commercially bankable projects, let's say in Burkina Faso, but most investors are not going to even look at the commercial bankability of the project because it's in Burkina Faso. So the second level of risk mitigation is done on a portfolio level, broadly speaking, right? So I think we're looking for a combination of that project level and the portfolio level in general.
Yeah, thank you. Now I'm looking here at more of the questions, and I think here's a question I can group a couple of questions. Liliana, you had pointed out the importance of and how much you value the fact that a significant number of proposals came from developing countries. Now, there are a couple of questions about the selection committee, but I think I'll pull that out and say, what are the steps that the initiative has taken to try to ensure that we are able to encourage proposals coming from developing countries, whether it's in the selection committee and what type of people we look at in the selection committee, or in some of the other processes. That's for Chris and for Liliana.
Well, I think it's something that you have to look in a comprehensive way. So, of course, at Convergence, you have many people, a very diverse and inclusive team. In the investment committee, we made sure that we have voices from developing countries. Through our networks and also through our offices, SEC offices, for example, that we have on the ground, we can reach out SDC as well. And going forward, we will even step up these efforts. And then I think going forward also, we should look at this model of teaming up. We had some of such proposals, right, where you had call it consortia or a team, mixed team, which I think is a great way to combine the joint forces. So I think we have a good level to start with, and there's much more that we can do.
Chris, anything you would add there on the lens that you apply as you are working through the selection?
Well, going through on Liliana's comment, I think we are very pleasantly surprised by the actual number of proposals coming from developing countries. The reality is it takes more effort, really, for us to collectively communicate to those project sponsors and those asset managers that are out there. And then secondly, all other things being equal, they're at a little bit of a comparative disadvantage in this respect. Investors, generally speaking, like diversification. They like diversification of countries, of projects, of sectors, and therefore the developing, a proposer coming out of a developing country generally is in that particular country, therefore is a little bit of a comparative disadvantage. So we're thinking about, how can, as Liliana said, by teaming up to get more proposals that are supported by individual developing countries that can be creating investment vehicles that'll be palatable to an investor that's looking for that diversification. I think that's one key thing that SIFI needs to think about as we move forward, because there's lots of that. Lots of great ideas coming out of Kenya, or lots of great ideas coming out of Mozambique, right? But the reality is investors want to have diversified, and how do we bring them together? That might be an interesting form moving forward.
Yeah. One of the questions here is actually about whether, let me see, regional proposals would have a higher chance of success over.
Well, I would say this in general, from a pure investor perspective, because investors who are investing in low and middle income countries, generally speaking, are probably not that active in arranging the individual assets themselves. They're looking for asset managers like Allianz Global Investors or IFC, we heard them, an organization that knows. So for example, BlackRock just recently closed the $670 million climate finance partnership. They're looking for that asset manager that actually knows the sector particularly well. But then in general, all other things being equal, funds and facilities and portfolio approaches are more palatable to the investors, while at the same time, how do you get that into the reality of individual countries? Because every country needs its project to be funded, right? And there's good examples on how we can actually combine those two together, but they're critical. Investors need diversification, but we need to get the money into individual projects, and how do we do that well in innovative finance and blended finance? And I think you'll see some examples soon on some examples that we think will do that well.
So is there room, to any of you, is there room in the initiative for direct investment or support of enterprises in developing countries?
Well, I would say generally there are other structures that are more efficient. If we look at pure from the efficiency point of view and scaling, so I would say it might be not excluded if we're looking at something very innovative to test that can be then taken over by a fund structure or so on. But that's not the main focus, I would say, of the initiative. Because if we're talking about scale, if we're talking about crowding in private capital and from institutional investors, we cannot operate on a company level.
Fair point.
Maybe to add to that, that this is something that we do as a foundation, as an individual foundation. We fund small companies to try and make them investable, so that an initiative like SIFI can then take it to scale. So I think SIFI, the objective of SIFI is not to fund necessarily direct investments, but there are other avenues for companies to get funding, whether that be foundations or even some donors that would fund specific enterprises.
And Laura, I might add one thing to that too. There are several companies that are actually essentially blended finance companies themselves, okay? So for example, there's something in Africa called the Africa Guarantee Fund. It's one legal entity, but it's out there actually providing guarantees for up to 54 African countries, up to many commercial banks. So that would be one vehicle. There are a couple other, for example, there's something called Garantco. Garantco is one legal entity, but then it goes out and provides guarantees for local currency debt going into multiple projects. I know the SIFI funders are very keen to be supporting individual companies like that, but think of it more of that's a company that is actually providing financial services that would attach to many, many, many projects out there.
And then, of course, there's also, as we expand the work of SIFI, then looking at technical assistance to specific companies that might be invested in by some of the funds that SIFI would be supporting. Liliana touched on the point of efficiency, and so I think that might be one of the last questions from the audience today, which is a process like this it's quite resource intensive. It is successful because of the expertise that is applied, but how can we make sure that the initiative is improving efficiencies in in the industry and in how this is being done.
I mean, I think the fact that we're pooling funding from different organizations is, in fact, trying to, do exactly that and try and be more efficient. I think as we're also reaching out to all of you in terms of joining us as a partner, that will also increase efficiencies. And you mentioned this earlier, we're trying to consolidate, not fragment further in order to get to more efficiencies. I think as we're thinking about the different windows that we have available in the CFI structure, that will also help build efficiencies. And some of the ways that we can be more efficient is also by addressing some of these barriers or bottlenecks on the framework conditions. So addressing those will also hopefully make the sector more efficient. So those would be the...
I just might add, who's from an organization that does a lot of this, I will say this, that the first call for proposals was due on June 30th. 76 different proposals have come in. All 76 of those proposals have gone through a rigorous assessment and evaluation process. They've all gone to an investment committee. Well, not all of them. The shortlisted ones have gone to an investment committee twice. And here we are essentially at the end of September, broadly speaking, 3 months later with the funders in a position to be able to announce who the shortlisted are. You benchmark that relative to other windows and other call for proposals, I think that's an incredibly efficient starting point. So if we can get even more efficient, I think that would be actually super. But I also go back to what Maya said. At Convergence, we see a systemic problem being there's a lack of catalytic capital available, and then whatever is available is allocated in a very fragmented, arguably unstrategic way. We've got 4 funders coming together to address that, to collaborate, to cooperate, and to aggregate, and that's incredibly important if we want to be really narrowing the investment gap in low and middle income countries. A little bit here and a little bit there isn't as useful as some of it coming together and mobilizing relatively larger solutions.
No, and absolutely, and kudos to you and your team on being able to process this many applications actually in such a short time. I hope you've been giving them some good vitamins to maintain their resilience.
And just to add, I think the pooling of funds, that's really what makes the difference and where we can capitalize on efficiency gain. On a short term, I wouldn't say it's inefficient. It's just when new partners come together, we need to learn from each other. We all have a bit different mandates, different processes, different rules how we operate, and that's something that going forward that we have a clear strategy and vision and are fully staffed. We will capitalize then very quickly by pooling the funds, and I think that's really great.
And maybe one last thing to add is on the efficiency pieces, as we are going to run an additional call for proposals, there are a lot of learnings that we had from this first call that we can then add into that second call, and identifying some of these organizations that maybe did not make it to the finalist list because it was such a competitive call, we might be able to also reach out to some others in order to facilitate that engagement and that process beyond just financial support.
Great. So one final question to you, Liliana and Maya, before I hand over to Josine for the very key information that we're all waiting for, and so we can get to know Josine just a little bit more. What do you hope to see next? Maya first.
Oh, me first. Okay, great. Next, I think what we haven't been able to do so far to the extent that we had planned is really engage with the ecosystem more broadly. So really seek out the impact investing ecosystem in Switzerland and beyond to try to together identify some of the bottlenecks and where we need to work together collaboratively to try and identify them and maybe then as CFI provide funding to solve those. So that's one thing I think that is really critical. The other piece is a call for an invitation for others to join us. How can we be more efficient? It is by making sure that we partner with others and we pool more funding to make this successful. And lastly, what we hope to see next is really engaging in these additional calls beyond innovation, and that's going to be the next call again, but also looking at that scale piece, and then obviously those framework conditions where I think the collaboration and the partnership, as I mentioned, is critical.
Thank you for that. Liliana, last words from you.
No, not much to add. I think after the innovation window, we will also obviously look at the second window, the product window on scaling. That will take a bit more time because, again, these are new parameters. We have to look at new concepts. So that's another piece of work for next year. Thanks.
Thank you. Thank you very much to my panelists. I hope everybody will join us for drinks afterwards. There'll be opportunity to engage with everybody a little bit more and ask some more questions, especially if you feel your question did not get answered yet today. But without further ado, a warm welcome to Josine. I think we can stay put, probably. Yeah, this is an exciting announcement, so and an exciting welcome. The newest member of the SDG Impact Finance Initiative. We're delighted to have you. Welcome aboard.
Thank you, Laura, for your warm words, and also to Ambassador Frutiger for the welcome here in Switzerland. I've been listening carefully to both of the panels, and it was a very rich conversation. Thank you for all the contributions. Given the important role of building bridges in that has been played in the setup of the SDG Impact Finance Initiative, it's especially meaningful for me to be here today. It's my first official engagement as an independent executive president of SIFI. I'm very passionate about what the initiative aims to achieve, and we need this kind of forward thinking. I will draw upon my experience of working with impact investors for the past 20 years, and especially over the past 3 years as a managing director of Aqua for All. Our organization designs very customized de-risking instruments to mobilize private capital from impact investors and financial institutions for the water sector. And of course, I'm looking forward to stretching beyond SDG 6 and support the development of innovative solutions for the other SDGs as well. But I think we mostly need to recognize that I've only recently joined the efforts and the amazing achievements over the past 10 months. It's always smart and very committed people that are bringing such initiatives to life. So there's a lot of big thank you for the teams of SECO and SDG, the Optimus Foundation, Credit Suisse, and of course the team of Convergence of coming up with the first results in very, very short time. I'm mostly echoing the words that have already been shared. There's so much said already about the impact finance sector. It's a growing sector, and we know that, but there's still a lack of very attractive de-risking instruments that allow investors to allocate more private capital. We have heard some wonderful examples of Letitia earlier in the panel. Thank you for that. And you also pointed out that there's not so many out there that are doing the same. So we need to step up our game. And I feel that it's not always necessarily a lack of funding. It's mostly a lack of understanding of how to structure the right propositions to be catalytic. And flexibility is key to achieve this. You already pointed out that we need to not limit investors into making sure that they invest necessarily in West Africa or for one particular SDG, because it will limit them. And on top of that, we also have the cost involved of very specific SDG investments and often very high perceived risk. We need more solutions that can both achieve the measurable progress towards the SDGs and allow for scaling. And Liliana, you already pointed out that we need to make sure that we mainstream and in such a way that we're also able to crowd in institutional investors. And as you just heard, In the first call of proposals, we aim to contribute to enlarging the number of solutions by selecting the most promising ones through a competition. And we are supporting them not only by funding, but also by expertise. And with so many applications, the competition was very tough. We received many interesting proposals. You already shared that with us, Chris. And we are very curious as to whom are the finalists. So 7 stood out, and they have 2 things in common. They have the potential for development impact, and they are prospects in attracting private investments. So you've been waiting for this, so without any further ado, I'm going to announce the 7 initiatives in alphabetic order. Are we going to pull them off, or shall I announce them? Thank you so much. First is Ad Opes. It's a micro-leasing fund, a fund supporting smallholder farmers and micro-enterprises in East Africa, targeting SDG 8, decent work. Then we have Blue Orchard Carbon Impact Strategy, a solution investing in impact forestry projects and targeting SDG 13. We have Cross-Boundary Carbon Fund for Nature-Based Solutions in Africa, which is a project finance fund providing debt for nature-based solutions in carbon projects. It's also SDG 13. We have Demeter Initiative. It's the Colibri Catalyst, a blended finance facility targeting nature-based climate solutions. Again, we're talking about SDG 13. There's Global Schools Forum, an impact-linked finance for low-cost private schools, private early child development and skill development providers. And this is a platform that will develop impact-linked loans targeting SDG 4, quality education. The 6th one is Ground Up Project, Ghana SDG SME Fund of Funds, a solution focusing on SMEs in Ghana and targeting all of the SDGs mentioned. So it's 4, 8, and 12, responsible consumption and production, as well as 13. And then we have, as a final on our list, Off-Grid Finance Limited. This solution will channel capital to agri-food businesses, making access to low-emission technology more affordable. This again targets SDG 13. Please join me in congratulating them. These proposals are now going through the final stages of the selection process of the SDG Impact Finance Initiative, and we will announce the winners, I think, by the end of the year. So what's ahead? The ambition is very clear. Laura pointed it out already. Initiative wants to raise 100 million in Swiss franc that catalyzes private investments of 1 billion. And we're looking at other public and private and philanthropic capital to join forces. And first up, we expect to launch a 2nd design funding call by the beginning of next year. Again, Convergence, thank you for your support. And we also plan to expand the scope beyond innovative new solutions. And I think it's also something that we addressed. It's pillar 2 and 3 that we're also going to focus on. And there we also support existing solutions to facilitate impact investors to move into investing for development. We should not reinvent the wheel, as there's already so much expertise out there. I mean, I'm amazed in the past 2 days. It's a lot, and we can definitely leverage on everything that we know and do already. And this is also my call to you. Please work with us and be part of co-designing workable solutions. We need you to participate in all of the work that we do. And there's no one size fits all. And we are aware of the multiple sectors and the geographies and that really require customized approaches. And we will work on that. And of course, we will also double down on collaboration with key stakeholders to strengthen the ecosystem. The narrative shared here at Building Bridges is that it's urgent to step up our game and to deliver on the goals. There's an understanding that we need to come up with solutions to smartly get the funding from the rich countries, as yesterday was pointed out many times, to be deployed where the need is very high. We know, all of us, that an unequal world is coming with a lot of threats, even at our doorsteps. In all of this, collaboration is key. So we look forward to working with all of you, by either whether it's through submitting your proposals or to support us through grant funding provision, or maybe even putting up your expertise to make sure that the ecosystem is well designed. And with these remarks, I'm going to hand over to Sabine again to do the final closing of the session, isn't it? Thank you.
What a job to do a closing note after such a rich session and so late in the day as well. I'll keep it really short. I, from Swiss Sustainable Finance, would like to congratulate again SECO and the two foundations of UBS and Credit Suisse in setting up such a promising initiative. And isn't this a public-private partnership by itself? So great to see what can result from it. I think we've learned in this session about the impressive breadth of interesting proposals that were handed in at CIFI, but also about the already existing products that make such a difference in the real world. A difference with all these challenges that we are facing as humanity. We've seen some great examples of how this can happen. A few of the key takeaways from me were there's a clear trade-off between being present in the more frontier markets and having a good leverage. Quite a difficult trade-off to make, actually. What I also took away is how important it is to actually develop local markets and that there are local investors too, as long as you bring products to the market that makes it possible for them to invest. How key it is also to build a good track record to actually crowd in institutional asset owners, and we definitely always see them shying away from this perceived or real risk of investing in such markets. So more work to be done on this. But definitely, I think we can be optimistic that at the next Building Bridges event, probably in a year's time, we will have more interesting stories to tell. Now I would like to close with saying thank you. Thank you to SECO for co-organizing this session. Thanks to all the organizers behind the scenes that contacted speakers and now also made the session run smoothly. Thanks to all the brilliant speakers that provided their insights, but by far not least, thanks to all of you who joined us for this session, who stayed with us for so long, and who will hopefully join us for drinks now to also toast to the founders of the SDG Impact Finance Initiative. Thanks for having been with us. We look forward to a further dialogue with you.